So welcome to the Midas brunch meeting. And for those of you who celebrate Diwali, a belated Diwali, I know it's been a busy week for Diwali and everything else. So I hope you had a lovely time together with your family. And it's a very important time for Sikhs and Hindus this time of year. Diwali is the festival of light. So I hope with my presentation, I will illuminate your minds with a bit more mortgage knowledge going forward. My name is Bob Singh. I call myself a mortgage strategist as opposed to a mortgage advisor, and I'll explain a little bit more about why that is later on in the program. Based in Hillingdon, that's our office picture just after the recent refurbishment. If you follow my Facebook page, you'll know that we had a slight accident. Some drunken driver in the middle of the night smashed their car into my office at high speed. So we had to close down for 4 or 5 weeks and get it all refurbished and replaced. Shop fronts, signage, everything. We had to basically start from scratch, and we had to go into temporary offices, which was a bit disruptive, but we had to do it. So Main Uxbridge Road on the corner of Pole Hill Road. So if anybody's passing by, please feel free to pop in for a cup of tea or coffee. You're always welcome. But yeah, as I said, we are experts in financial strategies because a mortgage is just part of the journey. It's the start of your property ownership dreams, whether you're a first-time buyer or a seasoned investor. Property has made many, many people wealthy, and it's one of the routes on top of your day job or business. And we are there to guide you in all the steps. I've been in financial services now for 40 years, despite my youthful looks. I am actually quite old. We started Chess back in 1999, but that was after a career in banking as an IFA, estate agent, investments advisor, and a property developer. So when it comes to experience on law, accounting, I was in the legal department of a big bank as well. So, you know, I've got a lot of deep knowledge into how banks function. On the retail side, I was also in the debt recovery division of a major bank, dealing with corporate insolvencies. So we've seen the good and the bad, and in my time, I've seen ups and downs in the property market, interest rate cycles, the economy, politically, etc., etc. So, you know, a lot of experience in my sort of 40 years I've been in the financial services sector. In my time, I have won quite a few awards. I was voted best broker by Pink Network on 3 or 4 occasions. I was one of the top producers for that network back in the late 2000s. And I've also had the pleasure of being a live advisor on LBC Radio, many local ethnic radio and TV channels, the local and the national press, and last month or the month before, I was mentioned in the Daily Mail financial section in the online version, as well as the Wednesday edition of the Financial Mail. So we've got a pretty good profile, and that's obviously on the back of lots and lots of experience in the mortgage sector. Now, these are my contact details. There's a landline for the office, and there's also my mobile number. WhatsApp is the best way to get in touch with me. I'm normally quick at returning my WhatsApp calls, often until quite late in the evening, much to the annoyance of my wife, but she's very understanding, thank God. She doesn't think it's my girlfriend on the phone, so that's a big plus. So email is there as well. So if you have any queries or questions or scenarios that you're not sure of, then please email me or WhatsApp me, and I'll do my best to answer to the best of my knowledge. That's what we're here for. Even if you don't use us for a mortgage, I'm here, Sam's here, Arth is here. You know, you have a very experienced team at Midas who can guide you in almost every sphere of properties and mortgages. Now, what do we do as mortgage strategists? Now, there's just a short list of what we do, and it's probably no different to many other brokers that you may have dealt with or are dealing with. But we do offer a little bit more. You know, we go behind the scenes. You know, we want to understand you as a person, because we offer a long-term relationship, because a mortgage isn't thank you, wham, bam, and you're done with. It's a long-term commitment. It's a 25-year commitment. You will need that mortgage reviewing, and it's our job to keep you in the loop. And when that time comes to renew your mortgage, we are there to help you assess the next one. Now, whether that's staying with the same bank or remortgaging, that will depend on your circumstances at that time. And we will make that decision for you, help you make that decision based on fact. So we want to know you as a person, as a family, as a wider family, because obviously many of you will understand where I'm coming from when I say that, because different cultures have different ways of functioning. They help each other. Parents are very keen for their children to get on the property ladder and expand the portfolio or carry on the business or the family business. And, we want to understand what your goals are, what your aims are, what your dreams are, so that we can be there for you and guide you the best way we can when it comes to a financial planning perspective. So as you can see that we don't just do basic mortgages, we do the whole shebang, from the very, very simple vanilla mortgages to the highly complex limited company stuff and the adverse credits and commercial deals, bridging, development, which take a lot of time. They're not easy things to sort out, given the risk appetite of banks these days. It's very, very tight. They're not keen to throw money away. They do assess the individual very, very carefully and make their decision accordingly. Now, they'll come back with a million questions. So this is no surprise, therefore, that nearly 85% of mortgage applications are done through people like me. That we are called intermediaries. We represent you as our customer to get the best deal from all the banks in the marketplace, whether that's residential, buy-to-let, or bridging or development. Then we know where to place that particular deal. So if you just cast your eye on that list, if you're contemplating any purchase or remortgage, or just have a few questions that you may want to answering, then please give us a call. Please send us a WhatsApp or an email, and we will do our best to answer that for you. Okay, so why do people come to brokers or intermediaries, or in my case, a mortgage strategist? It's because we do and can do the things that the high street lenders don't want to do, because they are not in the market of the specialist field. They want to lend to people who just want to borrow 4 times income, have no credit issues, good jobs, 10 years accounts. They're not in that risk profile where they'll take a bit of a risk and lend to somebody who's not quite right. There's a massive market now for people with adverse credit histories, people who maybe were bankrupt at one stage, and clever things that the high street banks don't do. So we are in the marketplace. We know pretty much what all the banks do, because we have software to help us when it comes to sourcing their criteria. So within a very short space of time, I know in the olden days we used to have to call every bank and say, can you do this, can you do that? But now there's software in place. Technology is moving on at a rather fast pace in our industry, and very soon it will all be automated. Give it 5 years, with the emergence of artificial intelligence, other technologies, the mortgage process will be a lot more streamlined on the vanilla side. Okay, where it's complex, where it's requires a bit more thought, a bit more planning, that market will remain, and that's the space that we sit in, where things aren't quite straightforward, where they need a bit more consideration, a bit more thought. So that's why people come to us. So looking down that list, as you can see, we help a lot of classes of people who have adverse histories, unusual properties, people who have many sources of income, not just earned income or not just self-employment income. We can do applications with 4 people on there. Now, 4 people, most high street banks don't want to know, because they know that in a real life situation, 4 people never stay together in a property. If 1 or 2 of them will one day want to leave and buy their own place, then what happens to the remaining 2? So, the high street banks tend to stay away from that market, but we have banks that will allow 4 people. So if that gets you the property that you want, you may be buying with your children, 2 children, parents. If it gets you the house, then we do have lenders that will take up to 4 incomes. lending to foreign nationals and buy-to-lets and expatriates, you know, is an area where the high street is not really interested. That's the domain for private banks and specialist banks to lend to that category of person. Other clever things like joint borrower, so, you know, sole proprietor. This is where you get a person or two people on the deeds, and maybe more on the loan itself. By doing that, for example, a parent helping their child to buy a property. If the parent joins the child on the deeds, then you get a stamp duty issue because it becomes the parent's second property. So we can do a mortgage where, yes, the parent is on the mortgage, but is not on the deeds. So therefore, avoiding the 3% stamp duty surcharge. So a lot of parents do that when they buy their children a property, maybe, you know, to live out near the university or whatever. It's a good way to save a bit of stamp duty and not affecting the child. You know, multi-unit blocks, multi-unit freehold blocks. You know, if you've got a block of flats, for example, and want to raise money on that, we have lenders that will lend on that. And obviously, the biggest hot potato in the flat market is the EWS1 certificate. This is where flats of a certain height, 18 meters or above, which have cladding, now need a EWS1 certificate. Otherwise, the banks simply do not lend. So there's millions and millions of people stuck in flats which they either can't sell, where the service charges have been hiked to ridiculous levels to pay for the removal and replacement of the cladding to a safer version. So it's going to be carrying on for many, many years, I feel, because there aren't enough EWS1 surveyors in the country to go around every flat. But, you know, we have lenders that are a little bit more relaxed, given the latest movements on that front. If a report has been done and nothing serious has been identified, even though it might not have an EWS1 certificate, then we do have lenders that will consider lending on a flat of that nature. So all is not lost. You must talk to us, tell us what the problem is, and then we'll see whether there's a way around it. But we're doing a couple of deals now where cladding was an issue, and we're managing to get those deals through. And obviously, using latest year's income for affordability. You know, no longer do you have to be providing 3 years accounts, and where the lenders used to average all three. We have banks that are now happy to lend on the latest year's figures only. So if you're showing a steady incline of profits, which is good for the business, they recognize that, you know, why take a figure of 3 years ago and penalize the guy who's now doing pretty well. So, you know, we have lenders that will take the latest year's figures no matter how big the increase. So if you suddenly go from 30,000 to 60,000, it no longer raises eyebrows with some lenders. Obviously, some lenders don't like it. They think the income is unsustainable. And we'll talk a bit more about that on the self-employed page, or when we come to that part of the show. Okay. And obviously portfolio schemes. You know, a lot of you guys are portfolios landlords. A portfolio landlord is somebody who has more than 3 buy-to-let properties in addition to their own residential. So as soon as you cross 3, you are classed as a portfolio landlord. And what that means is basically the lender wants to know that all the portfolio is performing well. So they do ask a bit more questions on that sort of application. They will want to know lending on everything, the rents on everything. They want to see the rents coming into the bank statements. We get a lot of cases where in family scenarios, you know, the children who may own the asset give the rent to their parents, for example. That's not the way it should be done. It needs to come into your bank account first, and then it can go out, because the banks want to see that you're actually showing that money in the bank account, and then obviously declaring it in your tax returns. So let's do everything by the book, because lenders are not very forgiving at the moment. So they want to see everything done properly. So yeah, we do what the banks don't do. And this is why having somebody who's a specialist is a good idea, because they can guide you through the marketplace and help you place your deals. Okay, so I think I've somehow pressed something here. Just go back. Sorry about this. I think I pressed a few more slides. Go back to here. Yeah, so here we are. So what else do we do apart from mortgages? We do, obviously, we're life insurance experts as well, critical illness, specialist critical illness policies where children are covered for free, which is a great advantage. Income replacement in the event of injury, and obviously a redundancy cover as well, which is hard to get these days, but it's a policy that is still available. And we also look at wills and trusts and lasting powers of attorney, and we do IHT mitigation strategies. So this is what I'm saying. So, having built up the wealth is half the equation. Protecting it and helping the future generations to actually enjoy that wealth is quite another. So, whilst you're doing great on the property side, why not then go the extra mile and make sure you're protecting the wealth as well? And that's where we come in as well, because having done the mortgage, it's our duty and responsibility to make sure, firstly, all your loans and debts are covered in case the worst happens. And we live in very uncertain times, as we all know. Anything can happen, and it's good to be protected. It's good to protect your loved ones, protect the estate, and make sure that what you're working for, I mean, how many of us work for ourselves? In many cultures, we like to see and prepare and set up the next generation, don't we? Every parent wants to do something for their children so that they maybe don't have to work as hard as what we had to do and what our parents and forefathers had to do on arriving in this country. So it's always a good idea then to look at the other aspects of your financial planning and make sure all the boxes are ticked, so that should the worst happen, your hard-earned money doesn't go to the taxman, and using trusts, etc. It's kept in the family, and you're building your intergenerational wealth. So it's very, very important that you also look into this as well. So today we are going to talk about how I feel the lending landscape is going to be next year. Then we'll go on to talk about how the banks are viewing borrowers who've taken perhaps financial assistance, and we'll talk about what sort of assistance they mean by that, and then talk about tips for the self-employed mortgage market. And then the last topic for today will be the family investment SPVs, which are taking on a great prominence, but it's important to understand what they are, how they function, the pros and cons of doing that as well. So we'll discuss that next. Okay, so what's going to happen next year? I still think it's going to be a fairly busy market next year. Yes, there are doomsters amongst us who think the market will crash, etc., but I just don't think the dynamics are there. Yes, a lot of people may lose their jobs, but that I think has already been factored into the market. I think that's a given. And the biggest news this week, which was good, was the vaccines. 2 or 3 manufacturers have now come up with a vaccine. That is a massive boost for the market, a vote of confidence, because as soon as everybody's vaccinated, then life should return to normal, and all those job losses that we had should come back. So I think whilst we might have a bit of a slowdown, I don't think it's going to crash. I think that's not going to happen. Interest rates are pretty low still. Base rate is 0.1. Could it go negative? Possibly. And obviously, we know what happens when that happens, because it's bad news basically, because banks have to pay you to keep their money. It's a different set of rules altogether, different set of dynamics when rates go negative. So, but it could happen in this country as well, like they did in Japan. So we are 0.1 base rate at the moment, and if you're old as me, you will remember base rates being 14-15% and paying 18% on your commercial finance. How bad was that? But now commercial finance is what, 4% thereabouts. So what a world of difference time makes. We've been through that, and I don't think the economy is strong enough to withstand any significant rate increase. Inflation is 0.7%, still well below the Bank of England's target of 2%. But I think next year inflation will edge up slightly as well. the market is busy, has been for quite a few months now since the stamp duty initiative was announced by Rishi Sunak. That ends obviously on the 31st of March. A lot of calls, a lot of loud noises coming from the conveyancing industry saying, please give us more time because they are inundated. Banks are inundated. You know, we're finding some lenders aren't even opening the post for 6 weeks and looking at the application, let alone, you know, do the valuation. They are that far behind. So the mad rush of mortgage applications has caught them quite unprepared, and a lot of people are working from home. So you get, you know, slight inefficiencies creeping in, and that's why there's a massive backlog, busy market, and some capacity issues at the banks. But I think prices will carry on rising long term, even though they might level off temporarily after the stamp duty period ends. Right now, the government hasn't said whether they will announce an increase in time for that, or, you know, whether they give us another 3 months, or whether they make it exchange by 31st of March next year rather than completion. That remains to be seen, but I personally don't think they'll be extending that because they've poured enough money into this already, and given that they are now seeking to claw it back, I don't think they'll go beyond the 31st of March deadline, because coincidentally, that's when the furlough scheme ends as well. You know, the furlough scheme ends in March. So I think the two schemes will pretty much end together, and we'll have to move on into the year and see how it goes. The good news is 95% mortgages, I think, will come back, which is music to the ears of first-time buyers, because they've been struggling all this year with having to find 15%. Even 90% was elusive. Lenders were coming into the market and then going out of the market at 90%, and but now they're beginning to come back. Banks have learned from this pandemic. They've educated themselves on how the economy works in a pandemic. They've realized which sectors get affected, and they are being a bit more reasonable now. And I think more and more banks will come in at the 90% level, not least in a bid to meet their end of year targets, because we're still middle of November. We've still got 4 or 5 weeks of the year left in terms of working and lending. So they want to meet those targets. So it could be some pretty good deals coming up towards the end of the year. So keep your eyes peeled for those rates. Excuse me. I think criteria will be relaxed slightly next year because of what I've just said. They have learned from their experiences this year, and let's look forward to that, because this year for people like me, it's been pretty tough because, you know, irrational decisions were being made by underwriters, and, you know, perfect clients were being declined mortgages. You know, not what we're used to, but it did happen. We'll see the emergence of interest-only options. Yes, on buy-to-let you get interest-only, but it wasn't so available on residential mortgages. So this week, one more lender came on board and said, yes, they will consider lending on an interest-only basis, but for a select few. Most banks have minimum earnings levels for this. They want you to be earning £50,000 or £75,000, sometimes even £100,000 to avail a interest-only facility. But as with anything, there are exceptions. So if you have a good deposit, and some lenders don't really worry about your income, they're happy to let you have an interest-only facility, providing there's enough equity in the property so that should the worst happen, should you not prepare for that day when they want their money back, there's enough money for you to sell that property and maybe buy something else to house yourself. So some lenders do have minimum equity levels, and that could be regional, it could be national. So, you know, 250 is a sensible level these days for most lenders, because 250,000 will buy you a one-bed flat in London, or on the outskirts at least anyway, or a nice house in the Midlands or whatever. So, and that is pretty much set at the national property price average, which is about 257. So most banks want that as equity, and then you can have your interest only and take your mortgage easily. Now, it's not good if that's not what you want to do. Interest only is there. Okay, it's a short-term measure to keep your payments low. Banks are merely introducing this so that if you did want to interest-only mortgage and keep your payments low for the next 4 or 5 years, that's fine. But that's fine when you're young, 35, 40, maybe up to say 50 even. But when you're in your 50s and 60s, it's not a good thing to do unless there's a means of paying that loan back at the end of the term. So it must be treated with great care when you take an interest-only mortgage. I know from my own experience that many people took interest-only mortgages back in the early 2000s, mid-90s, and still haven't done anything about it. So they're going to have a rude awakening when that letter comes and saying, please can we have the money back? So we then are there to help you, give you your options. If that's happening to you, we will tell you whether it's best to get a retirement interest-only mortgage or negotiate with another bank for a longer term interest-only mortgage. So, a lot of people are going to want that next year, I think. Negative rates are possible, which I've discussed before, and jobless and interest and inflation, I think, will rise as well, because and the furlough scheme has been extended until March next year, and we'll only really find out who's going to keep their jobs and who's going to lose them on the 1st of April. But yeah, and lenders, I think, will put up prices on their products. Even though base rate may not increase, they'll certainly want to make more money. They'll want to claw back some savings. They'll want to boost up their balance sheets, because this year many people have taken payment holidays. Money hasn't been flowing in as it used to. Their wallets are feeling a bit light, so they'll want to make a slightly higher profit in 2021. So I think margins will certainly increase. And if you follow the press, then you will have heard murmurs of tax increases. So I think that's going to come. The government has poured in billions and billions into the economy with grants and financial assistance, and that money has to be clawed back. So you can expect higher income tax, higher capital gains tax, higher corporation tax, possibly, which has a bearing on you guys who hold property in limited company format. So it could be a year that we start to pay back for all the generosity and the kindness shown by Rishi Sunak. I call him Dishy Rishi Claus because he has given us a lot of early Christmas presents, especially businesses. He's given us bounce back loans. He's given us Sybils, which was the coronavirus business interruption loan scheme. He's given grants to people who operated from premises, 10,000 or 15,000, depending on your rateable value. He's given us self-employment income support grants, furlough payments to the employers who couldn't actually pay their staff and had to furlough them for a while. As we know, furlough scheme has been extended until next March. So, still a lot of money the government's going to pay out until it all comes to an end. And obviously, payment holidays were allowed on your mortgages. If you haven't taken the full 6 months, you can now take them. But if you've taken 6 months already, then you can't have any more. Any future payment holidays, unfortunately, will affect your credit file. They will be registered on Experian or Equifax or Credit Karma, whatever. So if you take any more holidays, it will affect your score, and it will affect your ability to get further finance if the underwriter feels that you're possibly suffering from if you're suffering financially, and that's why you've taken a payment holiday. So they take everything negatively, unfortunately. So if you've taken all these grants, then fine. But when it comes to mortgages, lenders have a different viewpoint, which I'll come through and discuss a little bit later. So, how do the banks look at people then who have taken these incentives? Well, when it all sort of flared up in March and these benefits were announced, lenders were very, very nervous. They were very scared to lend to people because it was a brand new thing. We've never had a pandemic in this country, for 100 years. So it was all new to them. They were a little bit unprepared. So it was a knee-jerk reaction to refuse anyone and everyone who took out a bounce back loan, anybody who took out a payment holiday, anybody who took out any form of grant or government assistance. It was a blanket no, you cannot have the mortgage because you clearly have stated on your application that you are affected by COVID-19, that your business is affected by COVID-19, and therefore if your business is affected, your income will be affected naturally. So they took the negative view. If you had any of these on your bank statement, then they were going to say no. But as time has progressed, they've understood that it's not all doom and gloom. The bounce back loans were a source of cheap money, 2.5%, no interest for a year. Which businessman wouldn't take that, even as a precautionary measure? So they've realized that anybody who took these loans, it wasn't always the case that your business was in trouble. So now they're prepared to look at people who took them, maybe didn't use them, maybe the money is still sat in the account, maybe if they used a part of it, possibly for their business, which is what it's designed for. And some people actually gave their bounce back loans back to the loan and said, thank you, I didn't need it, thank you very much, I'm not in difficulty anymore, my business wasn't really as affected as I expected it to be, it's done rather well, therefore I don't need that liability on my head, please take it back. Some people have kept it, and they've replaced the bounce back money with their director's loans, for example. So if my company owed me £50,000, which is the money I put in when I set it all up, I took a bounce back loan, and then I've basically taken my money back out and left the bounce back loan as the company liability. So a bit of an accounting exercise that many people did, and many people have done that.
Sorry, Bob, can I ask you a quick question on that?
Sure.
Sorry to interrupt you during the presentation. With the bounce back loans, you mentioned there's some people that took it and then they gave it back because they felt, you know what, I don't really need it. But let's just say if this continues, can they then ask for it back, or it's too late?
No, I think there's a cut-off date for applications anyway, and banks aren't as free in giving them as they were. So I think once you give it back, you won't get it back again.
So it was advisable to sort of take the money, put in the account, and it's just sitting there. And that was a really good advice, wasn't it?
Yeah, people took it because nobody knew how long this thing would last, and now the vaccine is out. I think the government will be less keen to give more money out now, because they think there's a light at the end of the tunnel. As soon as everyone's vaccinated, we should be then free to resume our daily lives and go back to our businesses and everything else, and not have to close and social distance and all that. So, but if you've kept it and you don't need a mortgage, and it's cheap money, isn't it? 2.5%. It's a price of a buy-to-let mortgage.
You're right, but I mean, what you said in the start, I will actually put my camera on, so sorry. A lot of people use their traditions and the customs and say, well, do you know what, it's against my policy to actually take a bounce back loan, because I know with a lot of businesses who have been going on for about 20-30 years have never had to take a loan, fortunately, but all of a sudden it's kind of knocking on the confidence. So it was a big thing for a lot of businesses out there, so it was a massive thing. And I think the advice wasn't right either, so everyone was a little bit apprehensive, they were scared, they didn't know what to do, because like you said, this has never happened before in 100 years.
Yeah, the revenue is watchful of people who took bounce back loans where possibly they didn't qualify for them, or took out more than what their business turnover would ordinarily allow according to the rules. So I can see a lot of people being quizzed on that in the coming years, because you were only supposed to take, I think, 20 or 25% of your annual turnover. So if you weren't turning over 200, then how come you justified a £50,000 bounce back loan? So I think those sort of people will get quizzed. I think they're the people that need to worry and possibly consider giving the money back. But if you didn't take all of it, if you didn't take 50,000, you can go back and get some more if you qualify for it. Yeah.
Oh, yeah. Right, okay.
Yeah, you can take a second bite of the cherry. So if you didn't take the full 50,000 initially, because you felt you didn't want to go and push the boat out too far, you can now go back to your bank and say, look, actually, I do need that money, and could I have another 20,000 or whatever to get up to your 50,000 cap?
All right, we've got a couple. I know you still through the presentation. We've got a few hands up as well, and I am wary of time as well. So, do you want to wrap up the presentation, or should we go to the questions first and have you a bit interactive? It's your call completely, Bob.
Let me just see what I've got left
Sure.
to say. But yeah, obviously we were talking about all these documents and things like that, and people have taken loans. But this is the documentation that we actually need for self-employed people. Now, self-employed people are those that are in charge of their own destiny. You know, partners, directors, LLP people. You know, banks see you as self-employed. Even if you're a director and you're 100% shareholder and you take a salary from your company, you're not PAYE as far as the bank is concerned. Because you own 100% of your company, they deem you as self-employed. So, you know, they look at you as a high-risk customer because your business may not survive the pandemic or may be affected. So they look at you a bit more closely. If you're a director and your shareholding is only sort of 10 or 15%, then yes, you can be a PAYE considered person on a salary, and therefore your wage slips will be what they go by. Otherwise, it tends to be your tax returns, your accounts. And, you know, we need a lot of paperwork to back up your status. We can get mortgages for people that have just been trading for 1 year. We can use retained profits as well as your salary to boost your borrowing capacity. When it comes to buy-to-lets, we can use your earned income to top up any shortfall on the buy-to-lets. So there's lots and lots of schemes that we have access to that can help you as a buy-to-let investor, as a property buyer, as a businessman, and you know, we're there to help you. The last topic for today was the family investment company. This is where you buy a buy-to-let property or a commercial property, in fact, in the name of a SPV, limited company with the right SIC classifications. And it's basically a strategy to pass on wealth to your next generation, because you can put down your cash 25% or whatever you need to actually buy the asset. The rest will be bank finance. But the key here and the trick here is to create several classes of shares: voting, non-voting, growth, non-growth. So therefore, the parents would typically take the non-growth shares and they would allocate growth shares to their children so that the parents' estate does not grow in value over the next 2 or 3 decades. And so you're passing on your wealth, basically, that you would accrue on your side of the fence ordinarily, but passing that on to the next generation by having various classes of shares. It's quite tax efficient. We have tax advisors that will actually set up the company. They'll create a bespoke set of memorandum and articles, and banks will allow your children to be shareholders, sometimes up to 19% per child, and sometimes up to 49% as well. So, and even from the age of 1, believe it or not. So, you know, if you're really planning ahead, then it's something that you can use, but always take tax advice on a family investment company, because there are a few pitfalls. You know, you are giving the child a valuable asset, and then there are ways to mitigate and protect that in the event of a dissolved marriage or whatever. So these are the things that you need to look into and take advice on when considering a family investment company. So basically, if you find it, we'll fund it. But we'll work with you. We'll take down your circumstances. We will look at your goals and your aspirations and your risk profile and your, you know, financial capacity, and guide you accordingly. So thank you for watching, and yes, let's move on to the questions.
Right, brilliant. Thank you very much for that, Bob. I can't see your screen, so can't see you. Right, we're going to go straight to the questions now. I've got a few, but I'm going to wait. I've got a couple of hands up. So for those people that have got their hands up, I'm actually going to invite you to the panel, so we can see you and you can ask your question to Bob. So Tina, I've got you here. If you just want to unmute yourself and feel free to ask Bob a question.
Hi, can you hear me?
Yes, we can.
Yeah, hi Bob. I'm just
I can't hear him.
what the thinking is behind some of those people who you said they are basically taking out of their companies their directors' loans and replacing them with the government loans. What's the thinking behind doing that?
Bob, did you get that?
No, I can't hear a
Oh,
thing.
you can't hear anything.
No.
That's really odd. Do you know, put your volume? Can you hear me, Bob?
I can hear you perfectly, yeah.
All right, fine. So Tina was basically asking, what is the thinking about taking? Is it the government loan, right, Tina?
Yeah, the thinking around why directors are taking out their own loans and replacing them with government loans in their businesses.
Bob?
Yeah.
Why are directors taking out their own loans and replacing it with government loans? Oh, there you go.
Why are they doing that?
Yeah. What is the thinking behind that?
Just that it's another way of taking the money out and not using it, because bounce back loans weren't meant for personal use. Yeah, they were designed to sustain your business. So if you took the bounce back loan and kept it in the business and you wanted it for yourself, you couldn't do it. Because if you took money out of your company, for example, if it's a limited company, you would pay income tax on it. Whereas if you use the clever technique of replacing it with your director's loan, you didn't, because director's loans are repayable without any taxation. It's money back, isn't it?
Yeah, so it's the access to the money.
Can you hear me?
That's the important thing.
Yeah, we can hear you, Bob. We can't see a video though.
Okay, I've stopped sharing my screen, so I'm not sure. It says the Zoom meeting is not responding, so.
Oh, there you go. Tina, so was it the access you were asking about?
Yeah, so sorry, I was just
Because ordinarily these
so
funds
therefore
weren't
it's
meant
the
to be
access
used for
to their
personal
money
use.
and the tax. Sorry.
Sorry, there's a big echo there. So repeat that again, Tina.
So it was basically the purpose behind it was firstly the access to their own personal money, and secondly the fact that they wouldn't have to pay tax.
Bob, can you hear?
No, I can't.
All right. Bob, if you want to log out and log back in again, then maybe you'll be able to see you properly.
Okay.
Sorry about this, guys. Right, Tina, we'll be there with you in a moment. I'm just going to get Bob to relog it back in again. I think he's back. I think he's back. I'm not sure if he's relogging back in again. Yeah. We'll have him back in a second. While we're waiting for Bob to come through, if anyone's got any questions, you can either use the Q&A tab at the bottom or you can just raise your hand. They're just waiting for him to relog back in again. And there he's back. If you just want to unmute yourself, Bob.
Done.
Awesome, brilliant. Thank you for that. Sorry about that, guys. Tina's here. I hope you can hear her now. Go for it, Tina.
Hi, Tina.
Can you hear me, Bob?
I can hear you perfectly, thanks.
No, I was just saying, so the reason why, these directors are doing that is to have access to their own money, as you say, because they can't use the government money as their own personal money.
Yeah.
And also so they don't have to pay tax on taking out the government money. Is that the two main reasons?
That's the main reason, yeah. You can only do that if there was a director's loan there in the first place. Otherwise, if the money's come into your limited company and you've taken it out as a dividend or a salary, there's further tax to pay. So where you had a director's loan in the first place, you've basically done a bit of a swap and replaced the government debt. The company owes the government the money now, not you. That's all that's happened.
And the third question is, are they going to pay the government back, I guess, but we won't talk about that one.
Sorry, what was that?
I said the third question is, are they ever going to pay the government back that loan?
Ah, right. Yeah. Okay. I mean, depends what business you're in. You know, if you can walk away, I'm sure many will try and walk away. But, you know, obviously, those of us in the regulated sector or those that are professionals can't do that. And many will honor their liability, but there are, you know, there are elements, I know, people who have taken it and have no intention whatsoever of paying it back. So the government will be faced with a lot of losses, unfortunately, because it was
and
just,
we'll all be paying that back for years to come, the taxpayers.
absolutely, yeah, which is why I think our taxes will increase next year, not only to recoup what money has been paid out, but, you know, to cover some of the losses as well. But the government is pursuing people. I've known people that are being pursued for grants, claiming grants where businesses didn't actually exist. And obviously on the bounce back, it was so easy to get, wasn't it? It was a few clicks on the computer and 15 minutes, there's £50,000 in your bank account.
Yeah.
You know, it was abused. And the government need to send out a message here that if you did do that, there will be consequences, and it must be criminal prosecution, nothing else, because, you know, that will scare the lights of, you know, scare the living daylights out of people and make them pay it back. Otherwise, if it's just a slap on the hand, you know, you shouldn't have done that, and, you know, it's got to go to bankruptcy. You know, if you defrauded the state, it has to be treated harshly.
Yeah, agreed. Thank you.
Pleasure.
Thank you, Tina, for that. All right, we're going to go to Deepak. Deepak, if you just want to unmute yourself.
Hi.
Hi.
Morning. Can you hear me?
Yeah, we can hear you.
Yeah.
Yeah. Hi, Bob. So I had asked this question, in fact, when you were with Sam in the last seminar, I think a month back or so. Why the SPV limited company mortgage buy-to-let rate are so high? I need only 65% on a property of 260K, and 5-year fix is coming to be 4% if I include the admin fee, broker fee, setup fee, blah 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 fee. If I add all those fees which get added, it's come to around 4%. I know you advise for 65 the rates, I think you have 3%. So if you can get me 3% around it, I'm ready to be your next customer. Next 5 minutes.
Yeah, okay. We will take a look, because rates are up and down all the time. If you can come down to sort of 60% lending, it's much better. But it's a big bugbear of mine as well, because I can't see why they charge 1.5% more for doing exactly the same work, for lending on exactly the same property, just because it's a limited company. You know, I think it's
happy to go 60%. I'm happy to go 60% if you get me a good deal.
Then we can have a talk after the show. But yeah, I mean, I don't see why the banks, how they can justify charging 1.5% more for doing, as I've said, the same work, on lending on the same property, the same money, to the same people, to the same tenants. I really can't see a justification, except they see that as a commercial activity, and therefore they're trying to charge commercial rates rather than retail rates on the standard buy-to-let schemes. But as I agree with you. I don't think it's justified.
Okay, so can you get me a good rate? As I said, I'm ready to go.
I'll do my best for you.
Okay, if I can get your email or phone number, I can talk to you, definitely.
We can share that after the event. Happy to email that across to you.
Yeah, Arthur will send that to you.
Thank you. I'm done.
Thanks, Deepak. Some really interesting questions coming through, actually. There's one asking, do mortgages get granted if the interest rates are negative?
Yes, because the banks will make a margin above that. So it's not as if the banks are going to stop lending. They have to lend. Otherwise, they won't make any money. It's a big earner for the banks, because they pay your 0.1% on your deposit, which is effectively nothing, but they lend it on at, as we said, on companies for 3.5%. So they make a big profit. So even though rates are negative, lending won't stop.
Okay. Got another quick question here. Does buy-to-let mortgage have an age limit?
Yes, 100. So unless you plan to live longer than that, yeah, we can then talk at that point. But most mortgages have a cap of 95 or 100. So it will see me out, and it will probably see many people out.
It's changed over the years, hasn't it? Because I know that there wasn't an age limit of sort of retirement, 60, 65, and now they've increased it, right?
But yeah, many lenders will still cap it at 75 or 85 or 95. We can do 100 years old, but that's in your personal name. Now, companies live forever.
Yeah, in fact, that's moving on to another question, because someone's asked, is it possible to move one house into a limited as the company is in our personal names?
One house into a limited. Yeah, a lot of people are kind of contemplating it. It's not always possible. Well, it is possible, but it wouldn't be a good idea, because if you're transferring a buy-to-let that you've owned in your personal name for many, many years, and you don't qualify for the reliefs available for incorporation, then firstly, you'll have a capital gains tax triggered. And secondly, you'll pay stamp duty on the sale to the company. So the company will pay stamp duty. So it can work out quite expensive to do something like that. But if you're a full-time landlord and you're spending 20 hours a week managing your portfolio yourself, not using estate agents or anything, then there are provisions. If after a few years of running a partnership with your spouse, for example, you can incorporate that portfolio into a limited company and roll over the capital gains and not pay the stamp duty as well. So it's all down to planning. But for a single asset, it's debatable whether it would be worthwhile. But it could be if you're not making a big gain and you're happy to pay the stamp duty on the transfer. It could be that for going, in the years to come, the limited company may be more tax efficient because you can claim all the interest, whereas in your personal name, you only can claim a 20% tax credit. So for higher rate taxpayers, it's quite disadvantageous now to hold property in your personal names.
Interesting. There's a lot of questions coming through. Right, it's asking another question from Malcolm. Are you able to access funding for service apartments? I think that's directly to you, Bob. Yes,
we are. Yes, we prefer some experience in the buy-to-let sector, but we do have lenders that will lend on service apartments. 65% to 70% is probably the cap on that sort of score, but depends on where they are. A lot of people are moving into service departments. A lot of people are moving into the HMO sector, and a lot of people are moving into the holiday lets because the tax advantage is there. So whatever floats your boat.
All right, let's have a look. Anyone else want to ask a question and join us on the panel? You're more than welcome to. Just raise your hand. Another question is, all right, we've answered that one. Right, have a look through. Do lenders have an issue if your income comes 100% from property, as in your job? So that's basically your job in property. Or do they charge higher rates? For example, if you make 60,000 a year, but it comes from a high quality property. Thanks.
Okay. Ordinarily, lenders don't like all your income to be from rentals. They deem you as a professional landlord. So they'll walk away from it. But there are lenders that are a bit more understanding, a bit more realistic. So if you are a full-time property investor and all of your income is rental investment, again, as long as we can see that, as long as we've got details of the portfolio, your tax returns, demonstrating that you're declaring all the rents from there and you're paying your taxes, yes, we do have lenders that will lend to portfolio landlords.
Oh, okay. That's good to know. Hopefully that's answered your question, Tom. Right, it's going on. I've answered a few questions now. There is another question here. It's quite a long one, actually. They're not able to come onto the panel for some reason. I think it's because of the phone that you're using. They've recently been made redundant after 30 years in a job, but have some redundancy pay and a rental income of 3 buy-to-let properties. Can I get a remortgage for my buy-to-let and residential properties? There's a couple of questions here. So you want to answer that one first?
Yeah. Yeah. The good news is that for buy-to-lets, there is no minimum income. Yeah. Right. Most lenders, they do have a 25 or 50,000 pound minimum earnings level, but we, as a specialist, we have lenders that don't want any minimum income. So if you're redundant and your sole income is, whatever it may be from those rental properties, yes, we have lenders that will firstly let you buy a new buy-to-let. And if you've got an existing residential mortgage, then yes, we can get you a product transfer with that same bank possibly. Or if the rental income is high enough, we maybe then can look at another bank for you as well. So all is not lost. So income is essential for the regulated market, which is the properties that we live in. But when it comes to unregulated lending, like buy-to-lets or bridging, income is quite a secondary consideration. So yes,
Right.
we can help you.
Can one be eligible? The same person, they're asking, can one be eligible for a bounce back loan if I have only positive income of a small portfolio of buy-to-let properties but no other income? Or will she be classed as self-employed for this?
Yeah, I think you can talk to your bank. I think the window for applying for bounce back loans is quite short now. I think it's not much time left. But yeah, a buy-to-let, if it's a business, you can claim a bounce back loan for it.
Right.
There's no restrictions on you applying for a bounce back. If it's a property business, you can do that as long as you use it in that business.
All right. Got Karen. My buy-to-let has a LTV of 75%. If the property value dropped by 20% next year, when I remortgage, will I be stuck and unable to refinance? I think that's the situation for a lot of people out there.
Yes, Karen. Unfortunately, we can't predict the market. You know, when we take out a mortgage, it is a 25-year commitment, and in that time scale, property prices will rise, they will fall. But being in negative equity does limit your options because the banks keep a very watchful eye on property prices. They know what your property is worth because once they've lent the money to you, they will track the asset value. They have systems in place where they know exactly what your property is worth, and they use indexation. So if the indexes fall 20%, clearly your asset will be worth 20% less. There'll be hardly any equity, but the more reasonable lenders will still allow you to switch products, because when you come to the end of your deal, what you don't want to be doing is be stuck with a lender that charges a very high variable rate and doesn't give you any options whatsoever. So the good lenders, even though you might be in negative equity or have no equity, will still give you the option of coming onto a low product. So this is why I'm saying rates aren't everything. The quality of the lender is absolutely as important as a good rate, because what you don't want to be doing is going with a lender that doesn't offer you renewal products, and you don't want to go with a lender that doesn't treat you well down the line. It's all well and good getting the mortgage now, but how many mortgage prisoners are there in this world right now who can't do anything? You know, the FCA is trying desperately to help them to stop paying 5% and come back to paying 1.5%. And they're all stuck paying 5%, you know, poor people. So this is why, if anybody is stuck on that, there's hope on the horizon. The government is quite keen to help mortgage prisoners. And if you get a letter from the FCA or the bank saying, you know, you are free to go, then there are a few banks where you can go and get better products. But I can't see negative equity happening if you've got 25% equity in your property, unless there's a massive crash. So I don't think it's too much to worry about right now, Karen.
All right, brilliant. Well, at least it sounds already positive, so thanks for that. How are you for time, Bob? We've got a few more questions coming through. You
I'm fine.
More minutes?
Yeah.
Oh, brilliant. Anonymous, a mortgage was declined due to SEIS grant, and another lender declined due to an unknown error. They say here in brackets 700 and 500. 3 years ago for both a joint application. Is it worth a try elsewhere? Absolutely,
yeah. Yeah.
What is that grant? SEIS grant?
Self-Employment Income Support Scheme.
Right, okay.
It's SEISS, in fact.
Okay.
Yeah, this is basically a refund of taxation for what you might have paid in your taxes in the previous years. And there are another 2 payments due. So if you're self-employed and you have paid taxes, please speak to your accountant and claim those 2 grants. But as you've clearly said, banks don't like people who avail government funds because they think you're in trouble. So if you can prove that your business isn't affected, and this is why now for self-employed people, not only do they want your personal bank statements, they want your business bank statements for 6 months to show that there's still revenue coming in, you're still operating at similar levels, maybe pre-COVID. And with that demonstration, banks are now a lot more relaxed about people who've taken government grants and bounce back loans, as long as there's a logical explanation. And as for adverse credit history, if you've had defaults, even though they weren't your fault, if they appear on your file, the bank can't ignore them. They have to pay attention. They will ask you how and why it happened. But anything more than 3 years ago, we have lenders that will pretty say, that's fine. It's far too historic for us to be worried about. We'll treat you as a normal customer. Yes, those banks maybe charge you a little bit more, not always, but there's hope. So if you have adverse credit, if you have a low credit score, but not an adverse history, we have lenders that don't credit score. So, you know, it's case by case. There's no problem that we really can't guide you properly with. So if you're not quite ready yet, we can tell you when you'll be ready to apply for that mortgage. So,
Right.
so you need to do this.
That's a really good point, because I do look at some of the credit history as long as you can justify it. There are some lenders out there, aren't there?
Yeah, it was 3 years old. We've done cases where people have had CCJs and defaults 3 years ago, paid them off, but they still appear on the file for 6 years. And we've got them high street rates, which is fantastic. You know, rather than going to a subprime lender and paying 4 or 5%, they've ended up paying 2%. So, you know, so we will always make that effort to get you the best rate first.
See, I always thought it was 7 years. So
No, 6 years.
oh, is it 6 years? But
Yeah.
then if it's cleared off sort of, and it's as old as 3 years, you can find a really good lender for that person.
Yeah, generally.
Oh, brilliant. That's really good to hear. I'm learning a lot today, so I'm guess everyone's finding this session really valuable as well. Let's have a look for some more questions. I think we've answered that one as well. Do banks still provide mortgages until the age of 75? They've actually contacted a few, and they seem they can only provide until 70. But does it make a difference what kind of mortgage they're going for, if it's buy-to-let or residential?
Yes, buy-to-let, there's no issue. Residential, as I've said, it's regulated. So the banks are under a legal obligation to make sure you can pay that mortgage. So if you're going to the age of 75 and you're in a career which is going to mean that you're going to be retiring at the age of 68, what happens in the next 7 years? You know, if your income stops at the age of 68, how can they justify lending to you until the age of 75? So in those scenarios, they will look at your pension income.
Right.
So if your pension income is good, then they will use that pension income to justify that extra 7 years. It could be that you can take an interest-only mortgage, so affordability is then made easier. So there's lots of ways you can look at this. And obviously the worst case scenario is you consider an equity release mortgage, where you actually give away you know, a charge on the property, but you never ever pay any payments back per month until your last breath. You know, they'll sell the property at the end of that time. So a lot of solutions. I think you just got to see what's the best one for you.
Yeah, it depends on what situation you're in as well. There are loads of options out there. Loads of questions for you, Bob, about chess mortgages, whether you do mortgages for land, and your fees as well. So I'm pretty sure you can contact Bob. You've got his details as well, unless you want to answer that now. Let's have a look through.
Land, yes, with or without planning, it tends to be a bridging type application. So if there's planning on it, even better. You know, we'll fund maybe 50 or 60% of the land and 100% of the development. So if you're an experienced operator, you've only got to buy the land, and then we'll do the rest. So it can be a good way to get funding for the land and the development beyond that point. So yes, we do. Our fees are case by case. So we are not big charges or fees, but I think there is a price for our service. We'll discuss that on a case by case scenario, but you'll be surprised how low that is. But if it's a pretty difficult case, then yes, we might charge a bit more. The other thing to remember is banks do pay us as well, and we do earn commission from introducing business to these banks. It varies. That covers some of our costs, but it doesn't cover all the costs. So that's why we have to charge. We will also get commission from arranging your life cover, etc. So it depends on the deal. So it could be that we don't charge you anything at all. If it's a multi-million-pound deal, we may not charge you anything for that, because we'll be satisfied with what we get from the lender or the insurance company. So it's a case by case. What we really seek and yearn for is a long-term relationship. We want to be there for your financial needs and to make sure that firstly, you're fully protected. Secondly, you always have the best rate on your mortgages and that we can look after you for many, many years to come. It's not just me at Chess. I have a full team behind me. I have 3 administrators. So I'll do the face-to-face meetings or the Zoom meetings with you to assess your needs. It could be over a telephone conversation, and we'll get all your documentations in. I will assess them, and then my angels, they do all the processing. They'll be in touch with you to package that case, collect any missing documents, and key in the application. Follow it through. Chase the insurance companies for your medicals. Chase the banks for surveys and valuations. You know, there's a lot of background work that maybe people sometimes don't appreciate what goes on. And when you're holding on the telephone line for 1 hour waiting for the bank to answer,
there is a reason behind it, yeah.
And you've got 100 cases to do. It's not easy. It's a full professional practice. We don't work from home, so therefore we have to charge a fee.
Brilliant, thank you. I do love your vocab today, though, like your staff, your angels, and dishy rishi. So I think that's amazing. Thank you for that.
Yeah.
Quick question. I've got Jeanette. She wants to know a bit about bridging, but that's all you want to know about. There's different types of bridging, I think. If you want to come on the panel, you're more than welcome to ask Bob a question about bridging. I'm going to invite you. If you want to talk, that would be amazing. Jeanette, you are just rejoining as a panel member, but if you've got a question about bridging, I'm sure Bob can answer that. You need to unmute yourself. Hi, Jeanette.
Hello there, how are you doing?
Good, thank you. Now, you've got a question about bridging loans. Go for it.
Yeah, I was just asking if you want to start a business like buying in auction, and you want like a bridging loan to pay a part of it. How does it work, please? And
Okay.
the interest rate.
Okay. Bridging is becoming very, very popular. It's not just the auction market, it's now the retail market as well, because people are so keen to complete their transactions before the end of March, where they haven't sold their existing house and they're so keen to buy the next one. Bridging is taking on a fairly big prominence these days. So it's a growing market. But the good thing with that is it's also a very competitive market. There are 200 or so bridging lenders that we have access to. They're all keen for your business. So when you're using bridging to buy a property, the rates have dropped significantly over the years. You now can get bridging loans starting from just 0.5% a month.
Really? Wow.
Depending on the loan to value ratio. Average is about 0.7, 0.8 if you're borrowing sort of 70%. It doesn't get better than that because, you know, bridging lenders are there only to give you emergency funds. And the idea with a bridging loan is to buy something quickly, because as I've said, banks are weeks and weeks behind on applications. So to go and bid on a property on a standard mortgage would be suicide, really. So it's better to get a bridging loan, have it all ready, organized. So once the survey is done, it can go straight forward to solicitors and you can complete on your transactions. Yes, you're going to need a 30% deposit. Yes, you're going to have to roll up some interest because but what they typically do is they'll lend you up to 75% of the value. They'll deduct 6 months interest and their fees, give you the net figure, and you make up the rest. But they'll do it quickly. And for any month that you don't use of the 6 month or 1 year period which you take, you get that money back. You know, they're not there to keep your money, but they are volatile instruments. If you get it wrong, you could lose your money. You could lose the property. So they should be always treated with a bit of caution when you take a bridging loan. But we do a lot of auction finance. They work very well. But the key thing with auction finance is the property must be good. But bridging loans overlook that sometimes because you can buy tied property that would not ordinarily qualify for a buy-to-let mortgage. So, you know, but these days with online, no longer are all auction houses insisting on a 28-day completion. I've seen some where you've got 56 days. Therefore, you may not have to go down the bridging route, but it's good to have that as a backup. You can apply for a standard mortgage, and a buy-to-let. And if the standard mortgage comes within the 56-day period, you don't have to use the buy-to-let, and you've not paid anything for it. So it does depend on your circumstances, what you're buying, how long you've got, and obviously the state of the property, because bridging loans may be easy to get, but we have a duty to make sure we don't put you in a situation where you can't get out of. So what are your plans for the property when you buy it? What's it going to cost you? Do you have the money to fix the property? What's it going to be worth at the end of it? You know, effectively, you could borrow 100% in auctions, because, you know, if you've bought under value, the banks will look at the value, not what you paid for it. So some lucky people that we've done mortgages for have effectively got 100% finance. Win-win.
And you say it's short term, so no more than a year, right? On average. Well,
6 months.
6 months.
Yeah.
Not even a year, not even 12 months, 6 months.
If it's a big project, yes, you can have it for a year. But if it's a quick in and out, new kitchen, bathroom, you know, you can do that within a couple of months and then be out of it.
Right. Okay.
Yeah.
Yeah. Awesome. I've just had a quick look online. I forgot we were online for a moment there, but we've not had any questions through Facebook at the moment. I don't see there's any other questions that are outstanding.
I have a question.
Oh, actually. Hi. Go for it, Deepak.
Okay, so if it's an auction property or I buy property outright on cash, do it up, and I want to refinance, I know some people talk about 6 months. Is it possible to do it within maybe 3-4 months, or 4 months? Oh, sorry, 6 months, the hard line, which must pass before we can refinance property?
Okay, most lenders, because of anti-money laundering rules, make you wait 6 months. Okay, but there are exceptions. We do have lenders that will let you refinance it more, you know, as soon as you've pretty much done the work within that 6 month time frame, and it's then a question of, do they value it at the price you paid for it, or do they value it at the price that you've you know, at the end price, if you like. So every lender has its own rules, but there's nothing stopping you getting the money out straight away. But if you can wait 6 months, then you have a wider market choice of lender, basically. And if the interest rate isn't that much, it could be a good way to go. You know, you can borrow effectively 100% of the value and get that money back as well. So you not really put much money into the deal.
Yeah, so, thank you.
So the answer to your question is yes, you can refinance it before the 6 months is over.
Brilliant.
Thank you, Bob.
Thank you, Deepak. Right, it's nearly coming up to 12:30, and I know you are going to be going soon. I don't think there's any other questions coming up, so I actually just want to thank you for being on here, because I've actually learned a lot of valuable stuff when it comes to bounce back loans. I didn't know if you haven't taken the full amount, you can I've frozen there actually. Oh, sorry, I've frozen there. I didn't know you can actually go back and ask for more within the time limit as well. A lot I've learned, especially with SPV family investment as well. So thank you very much for sharing a lot of knowledge today. Always very valuable, Bob.
My pleasure. Thank you for having me.
No worries. My streaming has gone a bit funny. A lot of people are asking to share your details. I will be actually sending out an email later on today with Bob's contact details as well. Like you said, the best way to contact him is email and through WhatsApp as well. So I will be sharing the contact details as well. For those people who came a little bit late or left a little bit early, we will be this session is recorded and we will be putting this on YouTube later on as well. But if you have any other questions, feel free to drop Midas Property Group a call if you've got questions about buying or selling your property. And of course, when it comes down to finance and mortgages, we know that Bob is a person to go to. So thank you very much from Midas Property Group, and thank you very much from the attendees as well. We've had an amazing turnout. So thanks, Bob, for today's session.
Thank you, Arti. Goodbye, everyone.
No worries. Thank you very much, and enjoy your fish and chips.
Yes.
Thank you.
Bye-bye.
Thanks, guys. Thanks. Bye-bye.